So I have a clip I want to show you guys here that is James Lee, who's doing a partnership now with Breaking Points. He did a segment on stock buybacks, how they work, and why they are sort of absurd and harmful. Beneficial for the shareholders and executives, but harmful for the economy as a whole. So I thought this was a really fantastic segment. Want to make sure to show you guys this. This is James Lee talking about stock buybacks.
My name is James Lee. Welcome to another segment of 5149 on Breaking Points, where we dive into different topics at the intersection of business, politics, and society. And today I want to talk about stock buybacks, otherwise known as share repurchases. We hear a lot about it, so I want to take a few minutes today to dive deep into what it is, the common talking points, separating fact from fiction, recent policy changes, and the prolonged impact stock buybacks have on not only the individual companies engaging in that practice, but also on the overall health of the economy and society in general.
The debate around stock buybacks has to do with how companies use their cash. They have access to quite a bit of it right now. The tax cuts in 2017, relatively high earnings, and low interest rates have all added to corporate cash stockpiles. When a company is flush, it has options for what to do with its money. It can buy other companies, it can spend on research and development, it can buy new equipment, buildings, or technologies, or it can return money to shareholders. This can take the form of dividends or stock buybacks. In the past 10 years, the top 20 companies on the S&P 500 bought back about $1.3 trillion in shares, with Apple leading the way by far. In a stock buyback, a company purchases its own shares from shareholders and it takes them off the market, leaving fewer shares outstanding. This changes the math on the remaining shares in a key way. It boosts a metric called earnings per share, or EPS. The most basic equation for EPS is the company's net income divided by the number of outstanding shares. So when this number shrinks, the EPS rises. So if a company has a net income of $1,000 and has 100 shares outstanding, its EPS is $10. But if it buys back 10 of those shares, the EPS rises to $11.11. Higher per share earnings make stocks look good.
Making stocks look good. That really is the only ubiquitous North Star that drives American businesses. According to Reuters reporting from earlier this year, U.S. buybacks are at record highs. New repurchase announcements by U.S. companies reached over $300 billion in the first quarter of 2022, meaning that companies are on pace to buy back more than $1 trillion worth of their own shares this year. Compared to previous years, S&P 500 companies plowed around $880 billion into buying their own shares last year, up from $520 billion in 2020, according to S&P Dow Jones indices. Like the Wall Street Journal clip covered earlier, this is cash that companies could have used to expand their operations, spend on R&D and CapEx, dare I say, invest in their workforce, but they chose it to artificially inflate their earnings per share. Now, what's the issue here? Why should we be the ones to tell corporations and corporate executives how to spend their money? They are, after all, the experts in capital allocation, are they not?
Buybacks are an extremely important part of capital allocation across our economy. Buybacks are an extremely efficient way to reallocate capital. And nimble capital in America is what has driven our response to COVID. It is what has driven growth over time in combination with nimble labor, in combination with tech, education, healthcare. It's made America what it is.
Okay, a lot to unpack there from Mr. Jay Clayton, former chairman of the SEC. He talks about nimble capital driving a response to COVID. What I observed was the Federal Reserve jumping in to save big business by injecting more than $1.5 trillion into the market in March of 2020. He also talks about nimble labor, which basically refers to a company's ability to adjust their workforce up and down based on market demands. But what I saw was airlines and other businesses taking government bailout money that was supposed to go to preventing mass layoffs, and then exploiting a loophole to lay off the workers anyway. He talks about how buybacks are a, quote, extremely efficient way to reallocate capital. But if we look at what actually transpired in the days and months after the start of the COVID-19 pandemic, companies across many sectors, profitable companies, requested government bailouts because for years and years, they had spent all of their cash buying back their own stocks. Here's the New York Times in April of 2020. Last month, the top executives of KFC, Wendy's, Papa John's, and other large restaurant chains held an urgent call with President Trump about the coronavirus crisis. The companies needed billions of dollars in aid to avoid mass layoffs, the executive said. The next day, their trade group asked government leaders, including Mr. Trump, for $145 billion in relief. These companies had been highly profitable in recent years, yet they were seeking help from the federal government. Where had all their money gone? Like much of corporate America, the restaurant chains had spent a large chunk on buying back their own stock, a practice aimed at bolstering its price. I just want to say, if people like you and I did something like this, spent money with reckless abandon on luxuries, let's say a high-end car or a yacht to make us look richer than we are, and then went bankrupt, we would be roasted to no end. But these folks, the corporate and political elites, have no problems bashing welfare for the people while at the same time fully supporting corporate welfare, because that's exactly what this is. Companies misusing their cash to make them look more valuable than they are, and then when the going gets tough, hoping to be saved by government handouts. So I completely reject the notion that stock buybacks and repurchases are an extremely efficient way to reallocate capital, or even a great way to reward shareholders. Because let's say we were to entertain the shareholder primacy theory for a second, that corporations are to prioritize shareholder return above all other considerations. Stock buybacks aren't even necessarily the best way to do it.
The reality is, for share buybacks, you reward the people who are leaving and selling your stock instead of rewarding the people who are keeping your stock, right?
But that goes to the whole skin in the game thing, right? Don't people want skin in the game? Don't we want them to have skin in the game?
Yeah, the problem is that it's really easy to financial engineer with stock buybacks, right? There's just so many games that you can play, and it just creates a whole different set of problems. I think the fundamental issue is, do you want to reward your shareholders for staying via dividends? Wouldn't you want more people who are typically not shareholders to come in and own the shares of your stock?
Right, without getting too technical, the point Mark Cuban is trying to make here is that there are two primary ways to redistribute a company's earnings back to the shareholders, one via a stock buyback and the other via dividends. The former provides a short-term boost to the stock price, but can be manipulated easily by executives and company insiders. And the latter is usually a quarterly distribution to shareholders that reward, in theory, long-term investors for holding on to a company's shares. So if it's not the best way, why are stock buybacks oftentimes the preferred method of earnings redistribution? Well, according to a 2019 paper published by the Roosevelt Institute that analyzed transactional data of non-financial corporations with publicly traded stock from 2005 to 2017, the researchers found that net insider sales of over $100,000 are more than twice as common in quarters when stock buybacks are also occurring than in non-buyback quarters, and that in quarters with net insider sales, buybacks are more than twice as common as in quarters without net insider sales, meaning that senior corporate executives and other company insiders were personally enriching themselves above and beyond retail investors and other shareholders by timing their stock trades based on when these buybacks were happening, which of course they decide, with their gains coming at the expense of employees and other stakeholders. And more importantly, this paper also shows that this type of behavior isn't a one-off occurrence, but rather evidence of corporate cronyism at a systemic level. Another study conducted in 2017 by Robert Aries and Michael Olenek, professors at INSEAD, a top global business school, examined 1,839 public companies in the United States over a 5-year time scale and found that the more money a firm spends on buybacks, the less likely it is to grow over the long term. The chart on your screen shows that not only do stock buybacks not lead to a growth in a company's market value, they are actually strongly correlated to a declining market value. Those findings, to me, are not all that surprising. It's an indisputable fact that any money spent on a buyback, of course, can't be invested elsewhere in the company. But what makes this worse and far more dangerous for the overall health of the economy is that, fine, if you want to take on additional risk by using your company's free cash flow to buy back your own shares, okay, fine, that's up to you. But that's not what's actually happening in a majority of these cases. This is an alarming headline from Fortune magazine. More than half of all stock buybacks are now financed by debt. So it's not just that corporations are spending their own money to financially engineer metrics that make them appear more valuable than they actually are. They are borrowing money to do so, which is extremely precarious given the scale and prevalence of buybacks, like we talked about, on pace for over $1 trillion this year, right? It's one thing if a company takes on debt to finance investments in potential future productive capabilities like new facilities or R&D, but taking on debt to finance buybacks, which gives you zero revenue generating contributions that can help pay off this debt in the future, means that companies engaging in this practice are exposing themselves to a lot more financial risk in the long run. From the Harvard Business Review, quote, "Whether it is corporate debt or government debt that funds additional buybacks, it is the underlying problem of the corporate obsession with stock price performance that makes U.S. households more vulnerable to the boom and bust economy. Debt-financed buybacks reinforce financial fragility, but it is stock buybacks, however funded, that undermine the quest for equitable and stable economic growth." So yeah, buybacks have far-reaching negative implications for economic and societal stability. So let's take a moment to discuss recent policy changes addressing the issue of stock buybacks. Within the Inflation Reduction Act that has just been signed into law, there is a new 1% excise tax on corporate stock buybacks, presumably to rein in corporations and disincentivize them from engaging in this practice. Now, how does Wall Street feel about this?
The future of stock buybacks in focus today on word Democrats appear poised to pass their Inflation Reduction Act, which includes a new 1% excise tax on that practice. The question is whether it will, in fact, have a material impact or not, and what that might mean for stocks.
I don't really think it's a big deal. 1% buyback tax is about less than 0.5% to S&P 500 earnings, number one. I just don't think it's big enough for companies to change their strategy, and they're generating so much free cash flow, they do want to return it to shareholders. I think on the margin, maybe they shift incrementally to more dividends versus buybacks, but I don't think this is going to be material.
Interesting. The 1% tax is immaterial. Doesn't matter. You see, the thing we have to understand is that in this era of American politics, where there is an unlimited sum of money freely flowing back and forth between the government and the private sector, there are no laws on the books that aren't endorsed by the corporate elite. It may not be exactly what they want. In this instance, I'm certain that they would prefer no tax at all, but given the current climate and political sentiment, they can live with the 1%. In fact, it might even benefit them in the long run. David Dayen, in some great reporting, highlights this exact point in the American Prospect. Quote, "The bigger problem is that the excise tax cuts the government in on the buyback scam. Not only will shareholders and executives continue to benefit over workers and capital investment, but so will the U.S. Treasury. Henceforth, if you try to limit buybacks, which the Biden administration proposed in its 2023 budget, that will cost the government money. If you try to ban them, which the SEC could do simply by removing the safe harbor put in place in 1982 that effectively decriminalized the practice, that would cost the government even more." So I don't think it's an accident at all that the Inflation Reduction Act is riddled with corporate loopholes and handouts. It's corporate welfare in disguise. There is nothing in there that Wall Street can't live with. And if it's something they absolutely don't want to live with, it's 100% gone, a la the last minute removal of the carried interest tax provision. The point I'm trying to make is, don't be confused by the free market. There is always somebody making up the rules to the game. Senior corporate executives will forever be incentivized to enrich themselves and their shareholders without regard for their employees or society in general. And buybacks are a great example of this. Great for corporate insiders, but bad for everyone else. And if we acknowledge that there is maybe more to America than allowing a small group of people to make as much money as possible, then it's up to us, no matter how critical or skeptical we are of government power, to force our elected public servants to create rules and guardrails that decentralize power and put it back in the hands of the American people. That's it for me today. I hope you found this segment about stock buybacks to be helpful and informative. If you enjoyed it, I would encourage you to head on over and subscribe to my YouTube channel, 5149 with James Lee, where I make videos on topics related to business, politics, society. The link will be in the description below. Thank you for tuning in to Breaking Points, and as always, I appreciate your time.
Cable news is ripping us apart, dividing the country, making it impossible to...
Okay, wonderful breakdown there from James. There are two things that really stood out to me. First of all, I very much appreciate him just kind of going in depth about what stock buybacks actually are and the effect. He brought up charts and evidence, what they actually do. Not even good long-term business for the business engaging in the buybacks, let alone for the rest of us. There were 2 points that really stood out to me. First, I love that analogy of someone has to make the rules to the game that he mentioned at the end there. When you if you think about the economy as a market, who is setting the rules for that market? That is why the corruption exists on the by and large, because interests who have a lot to gain or lose by way of capital are going to find a way to buy off the person who is writing or people who are writing the rules. They want to win the game, so they're going to buy off the official, right? I love that analogy, and I think that's a really important way to look at it's a lot of this corruption and why it's there to start with. The second thing, he mentioned that in the long term, that 1% excise tax might actually benefit them. And what he was kind of trying to say is, because we misunderstand federal finance and we think that the government must be funded by tax dollars, if they ever actually go to ban stock buybacks, that will mean a hit to the tax revenue that the government is taking in, because they will be banning an activity that they're making a large sum of taxes on. So the misunderstanding of federal finance that we talk about a lot at Real Progressives and that a lot of MMTers are so focused on really does sort of like find its way into all of these different aspects of our political discourse. And that from James, I thought, was a very brilliant point. That, of course, if you're the banks, you're willing to pay a very small fee if you think it's going to make the government substantially less likely to take further action. And in a roundabout way, because so many people so misunderstand how the federal government is actually financed, there will be those arguing we can't ban stock buybacks because we're making X billion in taxes off of the stock buybacks. So fantastic point there. I think that is a very good example of how the sausage is made in D.C. And a wonderful breakdown there on stock buybacks from James Lee. Encourage you all to go check out his channel, 5149. I'm not familiar with him. I didn't know who he was until I saw him on Breaking Points there, but wonderful breakdown there, and I wanted to make sure to bring you all that clip.